Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, as part of a three-part series, Paul speaks with Alan Scharfstein, founder and CEO of middle market investment bank, the Dak Group, about the disruptive economy and the impact it has on company strategy and valuation.
We're speaking with Alan Scharfstein of the Dak Group, a mergers and acquisition group out of New Jersey, and he has got some interesting thoughts on maximizing business value in what he describes as a world of disruptive change. Alan, fire away.
Okay, Paul. Well, as business owners look at preserving, protecting, and growing the value of their businesses today, one of the greatest threats and one of the greatest opportunities is the fast pace at which business is moving and the fact that there is disruptive change occurring in almost every industry. Now, many business owners would say, but I have a company which is not a technology company. It's not operating on the cutting edge, and therefore disruptive change really doesn't impact my business. But that's really not the case. It affects most every business, and we can see that in a lot of places. We can take a look at it in terms of New York City, where the country's largest taxi fleet owner, who is a great success story on his own. He's a gentleman who emigrated here from the former Soviet Union, started as a taxi driver, built his business to where it owned over 900 New York taxi medallions worth nearly $1 billion. But he missed one thing. This brilliant operator missed the fact that Uber was coming to New York.
Right.
And that very fact materially changed his life and his business. The value of the medallions he owned by 40%. It created a situation where several banks moved against him to foreclose on loans. And
wow.
Here, what could one imagine as a more mundane and less technology-enabled business than a taxi fleet? But it impacted him dramatically. And so we're seeing that in almost every industry. We're seeing the fact that businesses are changing, and they're changing at a faster rate than ever before. And as a result of that, we're seeing sometimes explosive growth, sometimes consolidation, sometimes increased competition. We clearly are seeing decreased loyalty or stickiness of businesses, and we're seeing new technologies coming on board.
Well, and it's interesting that the whole concept, and Uber is part of this, of course, the whole new gig economy, as they call it, right? Where the barriers to actually performing a service are being broken down to such a granular level. I mean, and Uber, of course, being the great example of that, where basically every adult who has a driver's license becomes a competitor to a taxi, right?
Absolutely.
And I thought you had mentioned something about borders in a previous conversation, and how Amazon has kind of turned that world upside down. I guess that's another good example.
Yeah, absolutely true. I mean, if we take a look back in 2006, Borders and Amazon were both in the book distribution business, but both defining how they would address the changes in the business and do it very differently. And that in those days, you could have invested in either Borders or Amazon. If you had invested $10,000 in Amazon back then, you'd probably be worth around $200,000 today. You invested that same amount of money in Borders, you'd be out of all of it because it went bankrupt. And there was a choice. Two companies with significant market value back then just made very different choices as to where technology was going to take their business and how it was going to change the face of it. And as a result, very big differences. So these are the challenges that most business owners are facing today, because those who are looking ahead and trying to understand the change that's coming and trying to figure out how they deal with it are the ones who are going to survive and who are going to thrive. The flip side is that we take a look at many business owners who basically expect that they can run their businesses tomorrow the way they ran them yesterday. Those business owners are going to be very challenged out there in the market. The bottom line for business owners is you can't stand still. You have to move your business forward. You have to change your business plan. And you have to be looking ahead in terms of trying to figure out where the market is going and how your business is going to fit into that marketplace.
Yeah, and it's not just technology, is it? Because technology plays a role in it, in this disruptive world that we live in, certainly. But it's more than that. I mean, Amazon wins. Yeah, they had the technology and they had but they also built a pretty sophisticated supply chain vendor management system, and Walmart's another good example of that. Where it's not just technology. Technology perhaps enables these things, but it really is a new model of doing business, right? And that's the distinction between an Amazon and a Borders is actually quite illuminative, because it's not only technology, but it's almost every aspect of the business. How do you reach your customer? Amazon did it a very different way. How do you fulfill? How do you manage your vendors? Et cetera. It's more than just technology, isn't it?
Oh, it's absolutely. It's every part. It's how you define your business. What do you consider to be your core competencies in your business, and how do you leverage those? And again, companies can look at themselves and try to redefine who they are and how they're going to address their market. So I think, we take a look at all of these changes and significant changes that are coming forward with businesses, and we say, boy, that creates real risk for our businesses. And that's true. It does create real risk for businesses. But the flip side of looking at that is it creates real opportunities. The fact that business is moving faster, the fact that change is coming faster, for many businesses is really an opportunity. It really is the opportunity to grow your business at a faster rate. We know that customers are less loyal today than they ever have been in the past, that they will change more quickly. There's less stickiness to most businesses. We used to think that if a business owner ran his business well, produced a good product, provided it at a fair price, gave good customer service, that you could go to sleep every night as a business owner knowing that your customers would be there today, tomorrow, and into the future. That simply isn't the case anymore. Customers are making choices. Some of it may be because of foreign competition. Some of it may be because of new products coming onto the market. Some of it may be because people are developing better business models and better delivery engines than you might have. And so all of those are risks. The flip side is every one of those companies is growing faster than they ever did and creating new opportunities. And the fact that your customers are willing to move if you are delivering a better product or you using a better engine to deliver it has got to be viewed as an opportunity. And that's what businesses have to realize. They can't be afraid of change. They have to figure out how they're going to leverage it to their advantage.
Yeah, it's kind of the perpetual entrepreneurial model, isn't it? It really doesn't matter how large your business is. I mean, whether you're a $50 million company or you're a $150 million company or a $500 million company, the truth of the matter is entrepreneurial change is pretty much inherent in everything, isn't it? And it doesn't matter what size your company is.
That's absolutely true. And what we're also seeing is a company's ability to embrace change and adapt is becoming a real screening criteria of those looking to acquire businesses. It used to be that people looked at your business model, and if it worked, they were impressed and they might invest in it. Today, they're not only looking at your current business model, but they're also looking and saying, does this business have the flexibility in order to adapt to changes that are occurring in the environment? Because they're really looking not only at where you are right now, but they're looking at your ability to adapt to future changes. And that's driving investment, and it's driving valuation also.
And how do folks typically measure that in terms of acquirers, or maybe on the flip side for companies that are looking to acquire another company? How does one, because there's a certain intangible element to that, isn't there? That the ability to adapt, the ability to innovate. How do you measure that? Great an acquirer.
Question. It's a great question, and it's a fairly subjective type of measure. But what you are looking at is you're looking at the management team, the quality of the management team, the way management interacts with the company itself, and you're looking at how the business has changed over the last number of years. It's a great question to ask a business that you're looking to acquire, to define how they looked at themselves and what their business model was 5 years ago, 3 years ago, and last year. And if that business model is the same, then there may be, that may be a basis for some additional questioning and insight. If, in fact, you've seen a business that has adapted to change really well, has changed the way it addresses the market, has changed the way it meets customer needs, has changed the way it delivers its product, or it defines itself in the marketplace, that's a company which you might say just has the culture and has the acumen to be able to adapt to changes in its environment.
Is there a strong element, at least in your experience, is there a strong element to the relationship with employees in these types of companies that are adaptive and entrepreneurial? Because again, that's just one part of the mix, but it's a pretty important part of the mix. Do you have sort of a static employee group, that you have very, I don't know what the right word is, but less than dynamic interaction with, communications with. I would think that would be a reasonably important element too.
Yeah, it all goes down to the corporate culture, and so for example, those companies that change quickly typically have a high degree of employee involvement. Typically involve more employees in decision making, are typically more open. Those are companies that very often are adaptive to change. Those that are very much driven by the top, or in some ways autocratic in nature, are very often the ones that are less adaptive to change. And by the way, again, going to the issue of how you may evaluate an acquisition or how an acquirer may evaluate your company. When acquirers are looking at that, they're looking at that culture for a couple of reasons. One of them is you never want to be dependent upon one or two key people in an acquisition. You want to know that if you lose a person or two, something happens to them, their motivation declines, that you still have a business that has its legs, has its motivation, has its ability to grow. So you're looking at the depth of management, and you're looking at the level of involvement of a broader group of employees.
Come back tomorrow for part 2 of our discussion, when Paul and Alan will discuss the when, why, and how of selling your business.